Hi guys, my first YouTube video. Um, yeah, it's a bit rough, but I just was doing these calculations last night. I thought, you know what, I'm going to put this on YouTube because I think it's pretty interesting. So I've called it a positive case for investing in high yield funds, a balanced approach, or maybe better, a diversified approach. This is going to take 5 minutes, so it's a quick video, but I just found it a bit interesting, some of the numbers that came out. So it's not financial advice, it's for fun. Do your own calculations. My calculations are back of the envelope type of calculations. They're not to the decimal point, but they're close-ish. All right, but I guess the premise or the thesis or whatever the word is for describing this video is basically well, it's off the back of the calculations that I was doing last night, and just thinking, are these high yield funds the right way to go? I've got a portfolio that is all high yield funds, but it's very diversified, and I wanted to try and work out whether that's kind of the way to go with things. So I'll take you through it. Um, Let me go to the next screen. All right, so the assumptions based on the calculations that I've done, and I'll give you the outcome after when this is done. Um, we've got it's assuming that there's a you've got a highly diverse portfolio. So I've thought, well, if I'm going to go all in on high yield, I want to be very diversified. So that includes short ETFs, so ones that create income, but from shorts. Uh, Includes gold, includes silver, utilities, healthcare, but all high yield covered call ETFs. And it also assumes a reinvestment rate of 60%. So obviously with a 40% monthly withdrawal rate. Now, I know that there's people out there who will go, well, if it's really income, why are we reinvesting? Why should I be reinvesting all this money? Blah blah blah. And Jay from YieldMax been the first kind of to say, you should reinvest at least some portion of these, and he's right. Um, and I guess look at it this way too. Um, you know, if you own a shop, you have to reinvest to buy a stock in order to derive an income from it. If you are a mechanic, um, you have to upgrade equipment and you have to plow more money into it for supplies in order to create income, in order to fix cars. Even if you work in an office, um, you're reinvesting your income as well. So if you're eating, you need to eat. You need to have shelter. You need to have money for um, train or bus fares to get to work. If you don't pay these things, you can't derive an income. So it really shouldn't be any different for these particular funds. Um, they're not a free lunch. You need to be able to reinvest some money back into them. So I've got a 60% reinvestment rate, and that's what I've put into this. All right. So what I've done is, and again, I've just wanted to try and make this simplified and do it as quickly as possible. But um, I've picked out 6 ETFs um, that sort of, I wouldn't call it a broad spectrum, but give a little bit of diversification. Um, but before I do that, I just I kind of wanted to have a bit of a quick say about, firstly, let's talk about Misty, but just the redundancy of the term dividend yield percentage. I don't know. I think it's really redundant for these ETFs. I don't think they apply. So if you go to TradingView, Misty says the dividend yield percentage is 317.18%. I think a lot of investors particularly starting out, they look at that number, they go, "Oh wow, I'm going to make so much cash." Um, but if you look over the last, let's say, few months of the distribution of Misty, on average, and again, you might want to do your own calculations because, but on average, it's been yielding per month 5.9%. Now, if you annualize it, that's only 70%. So if moving forward, if essentially Misty um, goes sideways, um, it's really probably only going to pay around about the 70 percent mark, not 317. So you really need to take that into consideration, and that's what I've done with regards to these calculations that I'll have on the next page. But I've just chosen 6 tickers with um, some with gains, not really too many there with gains, maybe one with gain. The rest losing price over the last year. Dre and GLDY, they're less than a year, so I've just done an average for their per month loss or gain. So essentially, but I think these are good stocks to show because they've shown, a lot of them have shown considerable price decline. So AMZ in the last year has lost 17.26%. So that's a decline of 1.44% per month. Dre over its 2 months has gone up on average 1.89% per month. YMAG has lost 16%, which is a decline of negative 1.33% per month. YQQQ, which is the short, the yield max short for the NASDAQ 100, that's gone down negative 32.81%. Which is a decline per month of negative 2.73. RDTE, negative 19.45. It's declined negative 1.62 per month. And Goldie, over the 5 months, has been declining at negative 2.49%. I've chosen these stocks. Um, I've done it quickly, but I've tried to put some diversification into it. So you've got AMZ for retail and cloud services. We all know Amazon. DraftKings, YMAG, Magnificent Seven. YQQ is the short of the NASDAQ, so we've thrown a short in there. RDTE, we've thrown in an index income fund, and then Goldie, which is the Defiance Gold ETF. So got a short in there, got some gold in there, got an index in there, just to do a simplistic diversification. And I've chosen these stocks too because they're all generally around about the 40 to 50% dividend yield mark, which is, of course, high, but it's not high compared to others. So just wanted something middle of the range, except for YQQ. It's only got a dividend yield of 28.74%. But I wanted to throw a short into the mix as well as part of this sort of case portfolio. Now, the distribution per month for AMSI has been 4.25% roughly. DraftKings for the last 2 months, it's been 4.2% per month of the share price. So that's how much income the fund manager is deriving. YMAG 4.08%, YQQ 2.3%, RDTE 3.3%, and Goldie 3.2%. So what I've done is I've averaged the per month loss decline, decline or gain, and also I've averaged out the distribution per month as a percentage of these guys, and in order to make it more of the long lines of a consolidated portfolio. So on average, this small portfolio, in terms of the number of stocks in it, has been losing 1.29% per month. And I think that's a sort of a reasonable figure to illustrate NAV erosion. And in terms of the distributions per month, it's been averaging 3.56%. So let's go to some of these calculations. So I've used ChatGPT and DeepSeek, DeepSeek being the Temu version of ChatGPT. I've asked them the question: if I have a stock portfolio worth 100,000, so let's assume the previous stocks are equally weighted in a portfolio and it's all worth 100,000, and it declines in value by 1.29% per month, which is the average decline in the previous slide, and pays a monthly income which is 3.56% of the portfolio's value at the time. How much will its value be after 10 years if I reinvest 60%? And how much cash would I have withdrawn? Now, the reason why I've put it and pays a monthly income which is 3.56% of the portfolio's value at the time is because we don't want to use these yearly dividend yields. It's not going to give accurate data. You want to get a sense of what the fund manager is extracting per month based on the share price. Now, if the share price is declining, to me, this is a better way of looking at it. So what does ChatGPT come out with? Final results, the portfolio value after 10 years would be $277,000. So that's, gone up from 100,000 to 277,000 over a 10-year period. What I like most, though, that 40% that was withdrawn as cash is 297,000, nearly $298,000. So almost 28,000 on average a year. And then DeepSeek gives a pretty close number to that. So its calculation was $266,000 after 10 years. And how much cash was taken out? $285,000. And then just to make it a bit more exciting, I put in 20 years. ChatGPT gave a portfolio value after 20 years of 267,000, and cash withdrawn 1.12 million. Which I reckon is pretty good numbers based on a portfolio of 100,000. And then DeepSeek gave, again, fairly close, bit of a difference there of 708,200 and cash taken out about $1.04 million. So it goes to show that with some decline, but still a very good yield, it does come out with some good numbers over the long run. So food for thought. If you're worried about NAV erosion, again, I really think the way to combat NAV erosion is to have a diversified, very, very diversified portfolio, including income stocks or income option ETFs that are of a short of something. So YQQ, WNTR, which is the short of Misty, DIPS, which is the short of Nvidia, Fiat, which is the short of Coney. I really think it's important to have those in your portfolio. Even if you've got Misty, Coney, Nvidia, which I do, I've got the shorts of them too, and I'm just playing it on both sides. And I'll add money, reinvest money in as some of those decline. All right, guys. So I hope that was of interest to you. Again, it's not financial advice; it's just for fun and entertainment. Do your own calculations. Obviously, it's not like I can stop you. Feel free to use that prompt. Type in your own numbers, do your own calculations and see what you come up with. But I really think with these high yield funds, diversification and quite extensive diversification is the key to sustainability. Thanks for that.